Hey there, everyone. It's Mitch Goldberg. We are live. Thank you for joining me today. Welcome to a new live episode of Be the Boss of Your Money, because I want you to be the boss of your money, not your money to be the boss of you. What a week. It is another week in crazy land. I find myself truly exhausted when we get to Friday. So I will tell you this: it's been an interesting week. Today we have to make sense of the shocking, horrendous non-farm payroll numbers that came out today. Which I will tell you a few things about it, but it could have been a lot worse. In fact, I think it is a lot worse than what the numbers are telling you. Quick market wrap today, making sense of everything that happened this week so that we can get ready for next week. It's not just a matter of being ready for next week. It's also a matter of becoming more educated for the coming weeks, the coming seasons, the coming years. Because you really, if you can understand what's happening, you'll be more likely to stick with your investment plan. As I always like to say, what good is an investment plan if you can't stick with it? So let's roll the intro, and then we're going to dive into a whole bunch of things. All right, and we are back. Hey guys, I really appreciate all of you being here. So first of all, if you're watching this in the live stream, I would welcome your questions. I would love to see your words of encouragement. I'll be checking LinkedIn Live. I'll be checking Facebook. So hit me up with questions. If you're watching this in the replay, I'd like to welcome you too. And certainly if you have any questions, go ahead, ask away in the replay, and I'll get back to you on those as well. We're going to go through a quick market wrap. This is something that I do every single Friday, and it's something I enjoy doing. It's not just a matter of saying this is how much the market went up or how much the market went down. It's really a matter of saying why, what's the perspective, knowledge, experience, perspective, right? Those are the three things that count when you look at information, because we all have access to information. We can all see how much the major averages are. Many websites have that, but I want to add the perspective to it. So let's make sure we get to that. Okay. So today I like to do this little exercise every day and say, what shape of the day? The shape of the day is it a V-shaped recovery day, a U shape, a W shape, an L shape, check mark, Nike swoosh kind of day? Today was a V-shaped kind of day. So we have a V-shaped kind of day where, we had the market plunge, the economic plunge, and now investors and economic participants are betting on a quick recovery. So we have the down and then the bounce. I, for one, think it's going to take a longer time for us to bounce back to where we were before this recession and pandemic began. But I have also been saying that we could gain most of it back pretty quickly. States, what I've been saying, if you're a regular viewer of this show, I've been saying that states are going to open a lot quicker than we expect. Business is going to come back a lot quicker than we expect. I also said, I made a bold call. I said, I'll stick with it. If I'm wrong, I'll be the first to admit I'm wrong. But I said March 23rd was the low. I said this March 24th. I said March 23rd is the low. With all of the government stimulus taking over the private sector so that the private sector can rest and buy some time so we can get through at least a good enough chunk of this pandemic for people to get back to work, then that would be bullish. We've passed the low. I believe that more so now than I did before, because the further away you get from it, the less likely it is that you retest the low. There were a lot of people in the camp that say we have to retest lows because we always do, and they give statistical, past stats and all that. But the thing is, this bear market that we're in and this recession that we're in is so fast. It was such a condensed thing, such a condensed amount of time, that it's really, if you're going to apply past statistics, past experiences to what's happening now, you have to take those past experiences and then condense those in terms of time as well. And if you do that, then things might not look so different. Where it means that to me that how do I say this? I'm trying to choose my words carefully. That we've already seen our typical recession and bear market just in rapid speed. So let's get into this. Today was a V-shaped recovery day, and it was led by the right sectors. So we're going to do some share screens, and then we're going to get the heck out of here and start enjoying the weekend, okay? So let's take a look here at the sectors that led the way by taking a look at some of the ETFs that I cover for each different sector, the ETFs that I follow. Okay, so if you take a look at this, XLE, energy led the way. Energy had a very good week this week, up over 20%, probably about 24, 25% on the week for oil. So energy had a very good week. Industrials, that's the XLE was up for energy, XLI for industrials and building materials. I'd like to see financials right over here. So, at the top of the charts, you had the economically sensitive / cyclical sectors leading the way. And that's a V shape. That means investors are more confident about the future, and they're starting to factor that in. All right. Let's take another view over here. This here gives you the major averages. The Dow up 455, S&P up 48. That's a lot, 1.69%. NASDAQ up 1.58%. What you've been seeing, though, is the NASDAQ has been going up the most lately of the three major averages. Today, it went up the least. So it looks like other sectors are going up besides technology. Again, that's energy, industrial, materials, financials. And then you have the Russell 2000. Can you see that over here on the screen, the Russell 2000? I know a lot of you are watching on your smartphones, but the Russell 2000, that's your small cap benchmark, small companies. That's up 3.64%. So by far and wide, I'd say, by far, the small caps were the big winners of the day. They're also the biggest laggards, small caps. So it makes sense that when you have a strengthening economy, especially the domestic economy, that's when small caps can really shine. So they had a really good day. And something else I've been talking to a lot about is the VIX, the volatility index, or the fear gauge. This, I said to you a couple of days ago that this is getting close to 30. If we can see this go under 30, that would be very bullish for the stock market. And here we are. We're under 30. We're just about 28 on the VIX, down 11%. The VIX was 85 on March 23rd. So the VIX has really come down a lot. And even when the market actually starts to dip, you'd expect the VIX to go up, but it barely budges to the upside, but goes down a lot on the downside. That's the one benchmark that you actually want to see go down. Okay, so that's a couple of things over there. And then we're going to take a look at some of the big stats and the market movers. It gives us something to talk about. So let me just expand this. Okay, this is like the craziest chart you might ever see in your life. This is your typical non-farm payroll figures, and they kind of bounce around. This is going all the way back to World War II. It's a blip. But I want to show you something over here. You see this over here where my mouse is? That's the Great Recession. You can barely see it in terms of non-farm payrolls, jobs lost. And then you have this large line. This is now. This is 20.5 million jobs. So today, the non-farm payroll came out, delivered to us fresh by the Bureau of Labor Statistics. And the BLS came out and said we lost 20.5 million jobs. It was actually expected to be a loss of 21.5 million jobs. The unemployment rate went up to 14.7%. It was expected to go up to 16%. But these are ghastly numbers. These are painful numbers. And I don't get emotional about statistics except for now. These are very, very painful numbers. So from a market perspective, the stock market went up, though, because investors are getting ready for better times ahead, better, improving labor statistics going forward. So today's non-farm payroll, I call it's the Bill Murray of non-farm payrolls, because it just doesn't matter. We all knew that it was going to be horrendous. This is not new news. We knew things were going to be really bad. It's baked in already. Every Thursday, you have the unemployment claims come out. How you've heard 33.5 million Americans lost their jobs? Because every Thursday, the government tallies up how many people filed for unemployment claims. So we have 4 more Thursdays before the next non-farm payroll that's going to be announced in June. The May numbers will be announced June 5th. So June 5th is in 4 weeks. Okay. So if you think of it this, we've got 4 more unemployment claims numbers. If we could start seeing unemployment claims, only be negative $1 million, negative $500,000, maybe positive 200,000 or 300,000, that will really tell you that we are well past the worst of the pandemic and the economic crisis that it has caused. So that's what investors are banking on, and that's why you're seeing the stock market go up. There's other reasons, like people are crowding into the largest cap tech stocks like Microsoft, Amazon, Facebook, Netflix, Apple, and a few others, but those are the those and Alphabet, those Google, those are the big the heavyweights. So I'm just going to show you 2 more things. Let's see if I could minimize this and show you the next one. We're actually making pretty good time here, folks. So we're flying through this. Okay, these are the hardest hit sectors of the market since we went into this pandemic, and you can see that it goes by industry. Let me make this even a little bit bigger. Okay. You see here, the industry, leisure and hospitality, lost 7.6 million jobs. Education and health services, 2.5 million. And education and health services have been big drivers of new labor for a pretty long time. So it's a big shock to see those sectors lose so many jobs. Professional and business services, you see manufacturing, and these are millions of jobs. And it goes all the way down to financial services and finally down to utilities. It's hard to figure out why utilities would lose much jobs. I mean, 3,300 jobs in this report is not a whole hell of a lot, but still, you still have to turn on the lights every day. So go figure. So let's minimize this screen, and we're going to go to the next one. And this is the last share screen that we have, and we're moving pretty fast. Okay, this is the stock market, the coronavirus comeback. Right here, let me make this even bigger. Okay, you see that chart? This is the plunge. S&P 500 went down 34%. Okay, down 34% from peak. Partly the S&P 500 is an index. As you know, you cannot invest in an index, but you could invest in a security that tracks or mimics an index. Okay, and here we are, all the way back to 29.29. We're not quite yet to the 200 moving day average. But if you can see the S&P 500 cross over this orange line over here, that would be real significant. That would be a very bullish sign for investors to, put money back into the market that they maybe have taken out of the market. And for those people who are trying to get cute with the market and we're saying, oh, I'm going to wait till we have that really bad down day, the worst time, and that's when I'm going to put my money into the market. You already had that time. And it's a shame if you missed it, but it's not too late. Major averages are still down quite a ways from their peaks. Not really down so much, but down enough. We've had our recovery. And that's the issue, is if you're always waiting for the Sunday punch, you just might not get it. So we can't do that. And that's why investing consistently, time in the market as opposed to timing the market. All right. So I just want to tell you a couple of statistics. We'll get rid of the share screen. We're going to wrap this up in a couple of minutes. So let me tell you what the major averages are year to date, because when I speak to people about how much the major averages are down, people are surprised how little the major averages are down right now. For example, yesterday, the NASDAQ went into positive territory. So the NASDAQ is actually up on the year. Now, you wouldn't be surprised if you follow the big NASDAQ stocks like Amazon and Google and Microsoft and a few others and some biotech stocks. But the NASDAQ is the first of the major averages to peek its head back into positive territory since we went into the pandemic. As far as the S&P 500, that's down 9.3% as of today. So 9.3% after having a really good year in 2019. That's not the worst thing. I mean, 10% is considered correction territory. So Granted, maybe off about 12, 13%, 11% from all-time highs for the S&P. It's not that much though. So we're down less than 10% on the S&P on the year. If we just were down that amount now and you didn't realize how much volatility we had before, you would be like, oh, that's not so bad. I can live with that. It's just volatility. The Dow is off 14.7% year to date. One big reason for that is because of the pummeling that a lot of the manufacturing stocks have taken. In particular, Boeing. Boeing has lost about probably about 60 or 70% of its value from its high. So that's the worst performer in the Dow. Remember, we spoke about the Russell 2000 up about 3.5% today. The Russell 2000, the small cap index, that is still down 20. I have my notes here. It's down 20% year to date. So it's still way, way off. So a lot of people believe if they're going to look for pockets of value, pockets of the, you're looking for the next trend to make or the next investment to move, people are considering small cap stocks for that. But nevertheless, small cap stocks with an reopening of the economy could do particularly well. And lastly, EEM. EEM is the primary emerging markets exchange traded fund from iShares, and that's down about 18%. So emerging markets are lagging and small cap stocks. So now you know what's leading, you know what's lagging, and what else do we have here? Okay, so let's talk about the employment figures and why I thought they are worse than what the numbers show. And then we're gonna call it a day. So let me just check for any shout outs out here. I think I see a comment in my comments section. Hey, Bill, TGIF, surprised the market held up so well. I know what you mean, Bill. I'm telling you, this is, it's a big surprise for a lot of people, but we've been talking about that a lot here, about why and how the stock market could hold up so well, because the market had its big drop, very early in this pandemic, down 34% in 3 weeks or something. So we've already had our dip. So, the market's looking past the valley to the next peak is what's happening. Got a couple of likes out there. Dennis is out there. Dennis, thank you very much. Dennis O'Rourke. And we've got James Slaughter out there. James Slaughter is an incredibly talented financial advisor in Sacramento, California. And he was my guest. Him and Eric Hagan were my guests on this show yesterday. So if you have some time, go to my Facebook page or LinkedIn page, and you could catch our talk yesterday. It was about what's next for the financial services industry, what's next for clients, and things like that. Let me just take a look out there if anybody's out there in LinkedIn land. Fridays are always kind of a slow day. Although the weather's not so great today, so maybe, it's not a totally slow day. Okay, we've got a reaction out here from Christine Wasp. Christine, you've been a real supporter lately of my live stream, and I want you to know I greatly appreciate that. Thanks for always being out here. We've got a few people who are watching, being a little voyeuristic. Are you? You're watching. I see you out there because I see how many people are watching on both LinkedIn. There's a few and just a few on Facebook. But hey, listen, if you like it, ask a question, or your words of encouragement would always be appreciated. And so let's just take another quick thing here. So here's the deal with the non-farm payroll. A lot of people were furloughed and don't consider themselves unemployed. And a lot of people have not gotten onto the unemployment ranks yet. They haven't been able to collect unemployment yet. So, we've had a lot of stimulus, and everyone who received a stimulus check is, I'm sure, spent it by now. And you also have the PPP, the Payroll Protection Program, the EIDL program, EIDL, the Economic Disaster Loan. I forget what the I stands for. I've said it like 100 times today. This has been, like I said, this has been a long week, a long day. And you also have a mortgage forbearance. It's right now, banks can't foreclose on homeowners. Landlords can't evict any tenants at the moment. So had it not been for these kinds of measures, I do think things could have been a lot worse up to this point. But all of these were meant primarily so that we could buy some time and hopefully get through some of this pandemic so that we can start opening up the economy and getting states back open, which we must do, but do it carefully, considered, with patience, and really quickly lock down local areas where COVID-19 are starting to pop up. So that's my story for the day. I'll check one more time. Yesterday, I had a viewer who asked a question like right when we ended. He's like, "Hey, you didn't get to my question." I'm like, "Well, listen, it's we missed you. What can I tell you?" So, but we'll get back to him in the comments. Have a great weekend, everybody. Thank you so much. I'll see you on Monday at 4:30.